kick it off. All right, so the second task that we're going to go through today is in reference to the Unit 4 materials, which is to compute current taxes and deferred taxes. So the scenario is that you are a chartered accountant, you work for a company, you need to prepare the tax journal entries for the financial year. Okay. Now you are told that there are a number of key pieces of information that's going to be relevant to you for doing this, in addition to an extract of the balance sheet and the P&L, which you are given on the next page. So you can see that you have been provided with an extract of both the income statement and the balance sheet. Okay, so this is what the income statement looks like. You've got your revenue, you've got profit on a sale of investment, you have the accounting depreciation, accounting amortization, you've got accounting annual leave expense, you've got allowance for impairment losses, you've got entertainment expenses, you've got other expenses, you've got total expenses, and you have your accounting profit before tax. Okay, so that's what you're given on the P&L side. You are then given some information on the balance sheet side. Okay, so again, very similar to our earlier example with the cash flows, cash flow statement. We have the prior year balances, and we have the current year balances. Okay, for each of these different items, and across some of these accounts, such as depreciation, capitalized development costs, accumulated amortization, we have been given some notes. Okay, so what we can do is we can again refer back to the notes. So what exactly are we told? Okay, so we are told that number one is that the sale of an investment is not assessable for tax purposes. Okay, so that's quite important. We are told that accumulated depreciation for tax purposes was 100,000. Okay, so this was the prior year, and the current year tax depreciation is 50,000. Okay, there's been no disposals or additions. We are also told that all development expenditure incurred is capitalized by the company. Okay, all development expenditure incurred will be deducted in full. They will be deductible in full for they will be deductible in full for tax purposes in the year, giving rise to a tax deduction that's equal to the cost that has been incurred. Now, we're also told that the DTA balance, as at the end of the prior year, is related to two components. The first being 45,000, which is related to temporary differences, and 27,000, which relates to the conversion of carry forward tax losses. Okay, so 45,000 and 27,000 together gives us the 72,000 for deferred tax assets. We also have been told that 500,000 in share capital was issued on the 1st of July. Share issuance costs of 20,000 were incurred, okay, and have been debited against the share capital account. Now, these costs are deductible for tax purposes, with 4,000 being deductible in the year ending 30 June X3, which is our current year, and 16,000 will be deductible in future years. Okay. Some additional information, some further information is that entertainment expenses are not deductible for tax purposes when paid. The entertainment expense, employee entitlements are tax deductible when paid, entertainment expenses are not deductible at all. A bad debt deduction is allowed when they have been previously brought into account and they are specifically written off as being bad. And then the accounting treatment of accounts or transactions is assumed to be the same, except for cases that are otherwise stated. And we are told that the tax rate is 30%. So again, this is a really big question. It is, as you can see, it's quite complex. And so the approach that we're going to take is to break this down into each component. Now, the tax effect journal entries, really, if you think about what we covered last week, was that income tax expense is a combination of both current tax expense and deferred tax expense. So our approach for this question is going to be quite logical in the sense that we are going to be in a position where we need to calculate first the current taxes and then go on to the deferred taxes. So let us begin this wonderful journey of calculating our income tax expense. So income tax expenses, especially for current tax, there was a very nice worksheet which we mentioned last week. And so this is what the worksheet looks like. Okay, so you begin with accounting profit before tax. You then include any non-temporary difference adjustments. Okay, so things that are permanently not the same. Okay, so non-temporary just means permanent, so stuff that's just permanently different from accounting versus tax. The second component is you then make adjustments for temporary differences. And then finally, number three, you think about any transaction that has been in equity or OCI. If applicable, we also need to consider this idea of utilizing carry forward tax losses. And so when we put all of this stuff together, that is going to allow us to break down and reconcile this accounting profit before tax and reconcile this to our taxable income. Okay. So what do we do? So let's begin by working through what will be these non-temporary difference adjustments. So non-temporary just means permanent. Okay, so what are shrink the tools section? How do I shrink the tools? Okay, is that better? Yeah, okay. Yeah, sorry, look, I mean, when I share a screen, I can't see what the screen looks like. So, you know, I appreciate any sort of comments on that. So, and thank you for your response in the chat. So the first step is to think about permanent differences between accounting versus tax. So what are they? Well, we're told initially that the profit on the sale of investment is just not tax. It's just not recognized in tax. Okay. So what we need to do is, because this profit has been recognized for accounting, but not in tax, we need to get rid of it. Okay. At the same time, the second amount is this entertainment expenses. Okay, so we are told that entertainment cannot be deducted at all from a tax perspective. So therefore, we cannot include that in our taxable income, but we've included it already in accounting from an accounting perspective. So we need to add this one back, and we need to deduct this profit on sale. Okay, so these are our two permanent differences. Then we work through the temporary differences, okay? So a temporary difference simply means the treatment is going to be different at a point in time, but over time, they're going to be the same. Okay, so at a point in time, there'll be a difference, but through time, they're going to reconcile or net each other out. So what are they? Well, the first is this idea that an accounting depreciation is different from a tax depreciation. Now, we are told from the question that accounting depreciation was 100,000, okay? And that tax depreciation was 50,000, okay? So what we need to do in order to, again, move from the accounting towards the tax is that we need to, first of all, add back this accounting expense, and then we need to subtract the amount that is allowed for tax purposes, okay? Now you can see that this adjustment requires 2 lines, okay? So you got to add the accounting expense back, and then you got to deduct this amount for tax, okay? Now, if you don't like doing 2 entries for the one event, you can simply net them off, okay? And so if you net this, it'll be plus 50,000, okay? So regardless of which method you prefer, I leave that choice up to you, okay? But if you're wondering why there are so many adjustments here, it's because there are 2 line items for the one event, okay, just to illustrate that logic. So again, if we walk through where this 100,000 came from and where this 50,000 came from, we can go back to our question. Now, the accounting expense is going to be quite easy. Okay, we just simply need to look at the P&L. Okay, the accounting expense for depreciation is 100,000. Well, what about the tax depreciation? Where did we get that from? Now, tax depreciation is not going to be on the balance sheet, nor is it going to be on the income statement. That information came from the this additional section. So we are told that the tax depreciation for the year ended 30 June is 50,000. Okay, so that's how we obtained that piece of information. And then we continue working through these temporary adjustments. So again, this development amortization, from an accounting perspective, they've expensed it, but from a tax perspective, they give you all of the amount as a tax deduction. And so what we need to do is we need to add back this accounting amount, and then we need to deduct what is allowed from a tax perspective. Now we know that, and this is again in the additional information, that all development expenditure is going to be fully deductible, okay? Now, most tax authorities actually allow and encourage companies to invest into development or into research, which is why they give you quite a generous sort of rules for these deductions. And in fact, in the current coronavirus situation, most countries have enhanced these tax deductions for companies that are willing to invest. So then we get into this annual leave expense. Okay, so this annual leave expense, again, we just need to work out what is going to be the amount that is expensed versus what is going to be the amount that is ultimately paid. Okay, so again, the reason why this exists is because there's a different treatment between accounting versus tax. The annual leave expense from an accounting perspective is going to be found on the P&L, okay? But this annual leave that has been paid, okay, this 12,000, this amount we need to derive from a T account perspective, okay? So if you think about which accounts impact annual leave, okay, they are going to be annual leave expense, and they're going to be annual leave, like a leave liability, okay? So these are going to be the items that we need to investigate in order to calculate this 12,000 amount. So let us do that. So the P&L item, we know this annual leave here, which is 4,000. And then if we look at the annual leave liability, okay, you can see that the amount in the current year, okay, the closing balance is 22,000. The opening balance is 30,000, okay. So when we have annual leave expense, what is going to be the journal entry? The journal entry is going to be debit, annual leave expense, and then credit, annual leave liability, 4,000. So this credit amount, which is 30,000, is going to go up by 4,000 to 34,000. Now, the 34,000 is clearly not equal to 22,000, okay? But we need to work out that missing figure. And that missing figure is going to be 12,000. And this 12,000, what it represents is that it represents the leave that has actually been taken in the year. So it is this amount that will be allowed as a tax deduction, okay, rather than the 4,000, which is the annual leave expense. So we, again, use that information, we put it into our worksheet, and that's where we obtain this amount from. Okay, so the 4,000 and then the 12,000 here. We then go into this allowance for impairment losses, which is again an item that has been expensed from an accounting perspective. However, from a tax perspective, it's going to be the bad debts that have actually been written off that is ultimately allowed as the deduction. So in the same mechanism as what we did for the annual leave, we would look at where is the impairment loss found. Okay, that's the expense, very simple. But what about the bad debts that have actually been written off? Okay, so that we need to again look at the relevant balance sheet item, which in this case is going to be this allowance for impairment loss. Okay, so again, we can go back to our balance sheet. We look at this item here, and then maybe I'll set this one as a homework for you guys and see if you get the same number as what we have in this worksheet. Okay, so work through the same sort of process and logic as how I explained for the annual leave, and then see if you get the same number for the bad debts written off. And then that effectively squares up these temporary differences. Now, finally, we can go into the third component, which is going to be this equity or OCI adjustments. And we are told specifically in the other information that the share issuance cost, we're going to allow 4,000 as a tax deduction. Okay, so we take that information as a given. So when we sum up the amounts to date, we get this 147,000. But are we done with this problem? The answer is not yet, because we also need to consider the fact that there have been carry forward tax losses. Specifically, we are told in the other information that a component of the DTA is the result of a conversion of prior year tax losses. So what was that equal to? So DTAs relating to carry forward tax losses was 27,000. Now the material last week, we spoke about how we converted tax losses into DTAs. So a tax loss, so the amount of the tax loss multiplied by the tax rate is equal to the DTA. Okay, so the loss multiplied by the tax rate is equal to the DTA. We are told that the DTA is 27,000. We are also told that the tax rate is 30%. So if we divide 27,000 by 0.3, we're going to be able to back out what is the amount of the tax loss. But the question has told you that already. Okay? But I'm saying if the question didn't tell you that, now you know how to back that out. So the fact that we have carry forward tax losses means that we need to also offset taxable income against these carry forward tax losses. And so this is where we put in this amount here, which is this 90,000. We get taxable income, which is 57,000. We multiply that by 0.3, and that's our current tax liability. That is half of the question completed. Then we need to go on to the next step, which is to think about deferred taxes. So just like we talked about a worksheet for current taxes, we have a worksheet for deferred taxes. So the items here, we need to think about what are the carrying amounts, okay, and what is the tax base. Recall last week that a carrying amount is simply the amount that is recognized for accounting purposes. Now the carrying amount of these items here, okay, it's very easy to find. They're going to be on the balance sheet, okay, because the balance sheet measures items based on accounting rules. Okay. The tax base, on the other hand, is effectively a measure for what the carrying amount of the asset or the liability is if it was calculated under tax rules. So what we need to do is we need to think about what will be the tax bases for these items. So let's think about that. Now, here, if a tax balance sheet was in fact to be prepared, then 185,000 would be recognized for the trade receivable asset. Okay. Impairment loss is only going to be tax deductible once that has been written off. Okay, which means that in the accounting, from an accounting perspective, we've got trade receivables that we measured at 185,000 less this 40,000, less this allowance for impairment loss. So from an accounting carrying amount perspective, this amount is 145,000. However, for tax, it's saying that, hang on, I'm not going to allow you to recognize these impairment losses because I don't know if they have been incurred. So that is why the tax base for that item, for the receivables item, is going to be 185K. Buildings, okay, will have a tax written down value of 850,000. Okay, how did we calculate this? So this was in the other information. We were told that the tax depreciation, so this is the tax depreciation for the buildings, was 100,000 in the prior year and 50,000 for the current year. So buildings were acquired with a cost of 1 million. 1 million less 150,000 is 850,000. Capitalized development costs, okay, so this is with reference to those development costs, they will be fully tax deductible, okay? So the amount has already been tax deductible. So therefore, this amount is 0. Annual leave, again, is a tax deduction that only arises when it is taken, okay? And so this amount is also 0. Okay? We can't use what the accounting carrying amount is because we don't know if that's been taken. And then finally, for these share issuance costs, we are told that the tax base for that is going to be 16,000, which represents the future amount that will be deductible. And remember, in part 1, we only deducted 4,000 of those share issuance costs. If you're curious to understand how the tax treatment of share issuance costs is that in the ITAA 97, which is the preeminent Australian tax act, share issuance costs are known as a black hole expenditure, which the tax authorities allow as a 5-year straight line deduction. So any amount, divide that by 5, this is going to be your amount. And so if you're wondering where that came from, that is where it came from. So then, once we've computed that, okay, our table is now beginning to fill up. So once we've got the carrying amount and the tax base, we can then go and classify whether or not these are going to be our taxable temporary differences or whether or not they're going to be our deductible temporary differences. And so again, what we need to do is we need to make use of some of these rules. Okay, so the rules, go back, have a look at last week's material, is that if the carrying amount is greater than the tax base, then for an asset account, it's going to be a taxable temporary difference. If it's less, it'll be a deductible temporary difference. And then these two rules get switched around if we're dealing with the liability. So overall, we go through that exercise. We find that from a total temporary difference perspective, the TTDs are 80,000 in aggregate. The DTDs are going to be 212,000 in aggregate. And there's going to be the share issuance costs that represents a deductible amount. We'll put that in equity. Just as an aside, because this income, this item here ultimately goes through OCI. And so once we have this table, we are then in a position to record our final tax entries. Okay, so again, this table here calculates our balances. Okay, this calculates our balances for the DTL. This calculates the balance for the DTA. Okay, so remember what we need to do here is we need to look at the change in the balances, right, between the current year versus the prior year to work out what was the change in the current income year. And it's going to be the change that ultimately gets captured as the income tax expense. And we very much know what the prior year amounts are, okay? So we can easily take these balances, we subtract them from the prior year balances, we get the movement, and we bring all of that together in our journal entry here. Okay, so this is what it's going to look like. All right, so in particular, I would mention to you that this DTA here is reflecting the fact that we have indeed used up those carry forward tax losses. Okay. And so that's why there's a specific reference to this, and our current tax liability is what we calculated in step 1. This journal entry here captures the impact of those deferred, the movements in the deferred tax. Okay. And that is it. So I again highly recommend you go through both your both that cash flow problem and also the income tax expense problem at your own time. Okay, go through this, get your hands dirty. That's going to be the best way that you learn this. So let's me just quickly open up to any questions that you may have before we take another break. Thank you. All right. If there are no questions, let us. Oh, hang on. All of a sudden, there are questions potentially. So at year end, do we need to declare to the tax authority the current tax liability amount? So at the end of each year, the company needs to prepare a tax return. And so from that tax return, that is what ultimately gets paid to the tax authorities. Now, some companies, they do the tax return themselves, or they have internal teams that do that. Some other companies, they use an external accountant to help them do that. So the current tax liability is going to be reflective of the amount that gets paid to the tax authority, whereas income tax expense is going to reflect more than just that. It's going to also take into account the fact that there will be differences that exist between accounting and tax treatment of assets and liabilities. That's a great question. All right. Well, if that's it, let's take another break, and then we can then launch into the materials for units 5 and 7. So I will stop the meeting and I will talk to all of you very shortly. Thank you.